We should be rounding up on financial statement analysis. Financial statement analysis involves the analysis of a company financial statements, with a view to evaluating the company's past performance and to project future financial prospects. Financial statement analysis. All right. Let's see how we can minimize the breaking. Financial statement analysis. We explained that this is the evaluation of a company's financial statements with a view to assessing the company's past financial performance and also to predict the company's future financial prospects. We have solved a question relating to the evaluation of a company past performance. The question number 3 we solved in our last class. That question dealt with evaluation of a company past financial performance. Today, we want to look at projecting or predicting companies' future financial prospects. Today, we want to look at how can we use financial statements to predict or to forecast future financial prospects. Our plan tonight is to use financial statements to forecast a company's future financial prospects. Now, if you are required, to predict or to forecast a company financial statement. For example, you are given a financial statement for 2024. You are given a company financial statement for 2024. And you are required to forecast the company financial statement for 2025, 2026. This is what we refer to as projecting a company's future financial prospects. Please, if you are required to forecast a company financial statement, You are giving financial statement for 2024. And you are to forecast 2025 financial statements. At any time, you are required to forecast company financial statements. Please note, what the examiner is trying to test is your knowledge of accounting principles. If you are required to forecast company financial statements, you are giving financial statement for 2023. And you are required to forecast statements for 2024, 2025. Please note, if the examiner is texting financial statement prediction or financial statement forecasting, what the examiner is texting is your knowledge of accounting principles. Remember, under the accounting principle, for every debit entry, there must be a corresponding credit entry. Also remember, what are the items of the income statement? What are the components of income statement? You have your revenue, your cost of sales, you have your gross profit less operating expenses, you have your profit before interest and tax, then you are going to deduct your interest, you have profit after tax, then you are going to compute your tax and deduct your tax. You now get your profit after tax. From your profit before tax, you compute your profit, then you now get your profit after tax. So you must remember the components of income statements. Also remember, what are the components of statement of financial position? What are the components? You have your non-current assets. You have your current assets. Under your current assets, you have your inventory, your trade receivables, your cash and bank balance. Then you have your total assets. Non-current assets plus current assets will give you your total assets. Then you have your liabilities, current liabilities, non-current liabilities. Then you have your capital and reserves. Those are the components of statement of financial position. And lastly, you have the statement of cash flow. Cash flow statements. If I ask the student online, I have Deborah, I have Fidelis, I have Victor. What are the components of cash flow statements? You have your operating activities. You have your investing activities. Then you have your financing activities. So please note, if the examiner is texting financial statement prediction, what the examiner is trying to text is your knowledge of accounting principles. All right. It should be question 1. Let us look at question number 1. Now, before we go to this question, please confirm. Let's confirm individually. Do you have this question printed? Please, let us confirm individually. Do we have this question printed? Why am I asking this question? When we are done reading the question, we are going to move to the whiteboard. On the whiteboard, you don't have access to this question again. We are going to be using the printed copy. If you don't have the question printed, you may not be able to flow with the class. So please, I want us to confirm. Do you have this question printed? Do you have a printed copy? Deborah, Fidelis, and Victor. Please, can we confirm this?
I don't have it printed, but I'll be connected to my system now. So I'll be able to use the question and see the whiteboard as well.
Okay, good. Okay, you can connect to me, connect to your system, you look at it from your system, then you can also look at the whiteboard.
Yes, that's what I will do, sir.
All right, that's fine, please. Because we are trying to solve in class, you know. Instead, the solution is available, no doubt. But we're also trying to solve this in class. All right, so please, for others, if you have it printed, that's to our advantage. But if you have to be navigating from system, we have to manage it. All right, let's go to the question, please. Let me see the chart. No, it doesn't. With the whiteboard, you can't split the screen. So it's either you have it or you don't have it. With that whiteboard, you cannot share screen with the whiteboard. Akintola Williams, PSC, is a printing and publishing business. The business has traded very successfully for many years, largely on the basis of a lifestyle magazine, which has sold well due to recent fashion for such publications. The increase in the number of similar offerings from competitors, however, has resulted in a need to reinvigorate the product range. A plan to launch a new magazine title by the directors to increase revenue by 10%. Please note that. A plan to launch a new magazine, a plan to launch new magazine titles by the director is expected to increase revenue by 10% per annum for the foreseeable future. Okay, I can share now. I don't know what's happening to network. Between yesterday and today, it's been a whole lot of issue with the network. The overhead of the business should be unaffected by the expansion in sales. Other relevant information is as follows. 1, The level of competitive rivalry between the suppliers to the industry is very pronounced, and as a result, an increase in direct cost of only 8% per annum is expected. Okay. Next note. Working capital will be controlled in the same fashion as before, with no changes anticipated to the terms of trade. Thus, the amount of credit taking let's continue. I'm trying to get this, okay? Allow me to write fully now. This is just, let's continue, please. Now, I was trying to draw your attention to something. The amount of credit taken in proportion to revenue. Please note, credit taking represents your trade receivables. The amount of credit taken in proportion to revenue, that is trade receivables in proportion to revenue, and the credits given in proportion to direct cost will be unchanged. Credit given is your trade payables. Credit taken is your trade receivables. Please note that. The increase in the business will require increase in inventory of 5 million. Next, depreciation on non-current assets existing as at 30th December 2017 is forecast to be 7.5 million per annum annually. It is forecast that 10 million of new non-current assets will be needed. This, together with the new inventory, will be acquired in the year to 31st December 2018. Starting in the year of purchase, the company pays tax 21% per annum in the year in which the liability arises. Please note that taxation is paid in the same year liability arises. That is actual year basis. Capital allowance are available at the same rate of depreciation. Please note that capital allowance is the same as accounting depreciation. Please note that annual dividends are payable the year after the year in which the profits are earned. That implies that dividend is payable in arrears. Dividend for year 1 will be paid in year 2. Dividend for year 2 will be paid in year 3. The company intends to maintain the existing payout ratio. Okay. Summary financial statements. The income statement for 2017. Statement of financial position for 2017 is also given. Notes. The statement of financial position include dividend payables as a current liability because dividend for the year has not yet been paid. For the purpose of forecasting, dividends that will be paid must be included in the forecast. And so is included in the financial statement here for convenience. The proposed financing method are one, A1 for 5 rights issue at 5 naira per share. 2, the material should be in your mailbox. That material should be in your mailbox. It's sent to all students. But I wouldn't know why you don't have it. Once you are a registered student with your email, the material will come to you automatically. Okay. The proposed financing method are one, A1 for rights issue, A1 for 5 rights issue at 5 naira per share. 2, a 15 million naira term loan at 8% interest. Requirements A. Requirements A. Prepare for the 2 financing alternatives being considered by the directors of Akintola Williams. Prepare forecast income statement for the year 30th December 2018 and statement of financial position as at 30th December 2018. Now, do we understand these requirements? For the 2 financing alternatives, these are likely compulsory questions. Please go and check 2015. This was the 30 marks, something like this. 2015 May diet. Check 2017 November diet. Something like this was tested as 30 marks. Check 2020 COVID diet. Something like this was tested. And at any point in most cases, examiner always make this question number 1 question. Examiner says, for the 2 financing alternatives being considered, prepare forecast income statement. That means you are going to prepare income statement if the project is financed by rights issue. You are going to prepare income statement if the project is financed by 15% by 15 million naira loan, debt finance. When you are done, you also prepare statement of financial position. If the new project is financed by rights issue, you also prepare statement of financial position. If the new project is financed by, that is loan. So you can appreciate the depth of this question. All right. We should be moving to the whiteboard now. Although solution is available here, you have the solution here, but we are going to the whiteboard. If you don't have the question printed, because I will require, we are going to take it paragraph by paragraph. So I will require us that, okay, the first paragraph, let's read. Let's do the adjustment. Second paragraph, third paragraph, until we get to the final paragraphs and resolve the question. Let's go to it. We won't pay attention to limitation. So if you have the question printed, that's fine. If you don't have it, you might need to navigate your system twice. I'll move to the whiteboard. Please get your calculator closer to you. Get your writing pad. Imagine you are in a class and the solution is being solved in the classroom. Just 1 minute. Okay. Trying to get my pen. Electronic pen. All right, let's go to it. Remember the requirements. Requirement is to prepare forecast income statements. Look at it. Forecast income statements. For 20.
Hello, sir. Please. I'm sorry, sir. Hello, sir.
Yeah, I can hear you. Please go ahead and
Sir,
speak.
which topic are we actually treating?
Are you joining the
Which
class for
topic
the
are we
first
actually
time?
treating?
Are you joining this class for the
No,
first time?
sir.
Okay, were you in class last
I'm a
week?
bit confused.
I
was in class last week, sir.
I'm also more I don't know what word to use. Because if you are following the class, we're treating financial statement analysis. When I kick off this class, I started by saying we are dealing with financial statement analysis. So I'm a bit, I'm displayed with, so what topic am I taking? You understand it? I don't know how to hide it.
So I know it's financial analysis, but I can't find the material even in my mailbox. So I was now like, I
So
checked
you know,
through.
that's why. Just 1 minute. If you said you cannot find in your mailbox, do you have it last week? Do you have that material last week? Hello?
I think I do.
So you know when you say which topic are we take, it's like, I don't even know what we are doing. I don't know what he's talking about. The same material was shared. This is the third lecture on financial statement analysis. The same material we started with. This should be the third week. So that's why I'm a bit like, are you following the class trend? Do you understand it? Sorry if I'm a bit, but I'm just like, which topic am I taking? Do you understand this? I'm sorry if I'm a bit, it just take me on that. Have I been speaking that somebody doesn't understand what I'm saying? I've spoken for, before even the question, I've spoken for 30 minutes doing a recap of financial statement analysis. That was why I said, ordinarily, we are not supposed to share on that platform, on the WhatsApp platform. Only bona fide students will have this material. That was why the thing must be shared to your mail. It is not allowed to share on WhatsApp platform because that platform, some students are there. They are not on the online class. I can see the student has shared it. So if you are a bona fide student, it should be in your mailbox. The student that has shared this has done it in good faith. But there's a reason why management say, do not share material on that platform. We are sending to the student's email directly. You pay for the service. Some are not paying for the service. All right, let's go on. So I'm sorry if I'm a bit, it takes me as a bit aback that, what am I doing? And so I'm sorry. So we are dealing with financial statement analysis. Okay. We also have forecast statements of financial position. You are going to do for 2018 again. I need to make this one clear. I need to remove this for 2018. If we have equity finance, equity, that is right issue. 2018, if you have debt finance, that is loan. Let me take this one off. And I have my 30, my 30. Let me take this one off first. You have equity, debt. So we are dealing with financial statement analysis. Last week, the question we solved is on financial performance evaluation. The question we want to solve tonight is on financial statements forecasting. You are giving 2017 statement. 2017 statement. You now want to forecast 2018. That 2018, if the new project is financed by equity, what is the income statement? Alternatively, if the new project is financed by debt, what is the income statement? You are giving 2017, trying to see if I can manage. Okay, I should be able to manage here now. Now let's go back to the question. Let's go back to the question. Look at paragraph 1. Look at paragraph 1. We are going to deal with it paragraph by paragraph. I'm back to the question. You may not be able to see it. I'm not sharing it. Akintola Williams is a printing and publishing business. The business has traded very successfully for many years, largely on the basis of a lifestyle magazine, which has sold well, different fashion for such publication. The increase in similar offering from competitors, however, has resulted in a need to reinvigorate the product range. We don't have anything yet. Second paragraph, a plan to launch new magazine titles by the director is expected to increase revenue by 10% per annum for the foreseeable future. Please check 2017. What was revenue 2017? Please check. Revenue 2017. Look at the income statement for 2017. What was the revenue? Can we see it? Can we see the revenue? Yes, can we see that revenue? 2017 revenue. What was the figure? If you have the question, can you tell us the revenue? 2017. Look at the income statement. So we don't have the question printed. Oh. Okay. Okay. Please look at the revenue. Look at what I've read. A plan to launch new magazine titles by the director is expected to increase revenue by 10% for the foreseeable future. In order to finance the expansion, now look at it. That means our revenue in 2017 was 81,000. Revenue will increase by 10%. Please increase by 10% revenue. What do you have? What will be revenue for 2018? Increase this by 10%. What do you have, please? Please increase this by 10%. What do you have? What will be the revenue now?
So 89,100.
So if I go to that, do you have the question printed?
No, sir, I don't.
It's actually frustrating. The second paragraph, we are going to increase revenue by 10%. Look at that, please. So whether the new project is financed by equity or the new project is financed by debt, revenue will increase by 10%. In 2017, the revenue was 81,000. Look at it here, please. 2017, revenue was 81,000. Now, if revenue increased by 10%, that means in 2018, revenue will be 89,100. Whether you finance the project by equity, the revenue will be 89,100. If you finance the new project by debt, the revenue will still be 89,100. So we have resolved that. We move on. Still in paragraph 2. Still in paragraph 2, look at it. In order to finance the expansion, the directors are considering either a rights issue. Rights issue is equity financing or new debt. Next, the overhead of the business should not be affected by the expansion in sales. Please, what is overhead cost? Please, what is overhead cost? The line is open. What do you understand by overhead cost? The line is open. Please note, overhead costs are indirect costs. These are costs incurred, but cannot be traced to a particular product. For example, your rents, the business rents. So please note, overhead costs represent indirect costs. So you can go back to the question. Let's look at it. In 2017, please look at it. Indirect cost, look at 2017 income statements. Indirect cost was 12,000. Examiner says the overhead cost will not be affected. That means in 2018, indirect cost will still remain 12,000. So go to your solution. Look at it, please. Please look at it. In 2017, indirect cost was 12,000. In 2018, whether we finance the project by equity or we finance the project by debt, the level of competitive rivalry between suppliers to the industry is very pronounced. As a result, an increase in indirect cost of 8%. Look at that. Indirect cost will increased by, now check the question. What was the indirect cost in 2017? Please check the question. Indirect cost 2017, how much? 45,600. This will increase by 8%. Please increase this by 8%. What do you have? Please increase 45,600 by 8%. What?
49,248.
49,248. Can we all see it? Whether you finance the new projects, you observe that the items that we saw in that paragraph has to do with income statement, revenue, direct cost will increase by 8%, revenue increased by 10%. Look at it, please. 49,248. Whether you finance the new project by equity or debt, you are going to open the two accounts together. 2018 equity financing, 2018 debt financing. We're not going to treat it simultaneously. Remember, you are battling with time in the exam hall. We are here, please look at it. Working capital will be controlled in the same fashion as before, with no changes anticipated to the terms of trade. Thus, the amount of credit taken in proportion to revenue. Please, your credit taking is your trade receivables as a percentage of revenue. Examiner says this will not change. We remain unchanged. Now let's check 2017. Please check 2017. Receivables 2017, 14,700 as a percentage of revenue or proportion of revenue. Revenue 2017, 81,000. Please work this out. If you are to work that out, how you are going to do, please look at it. If you are to work that out, you are going to have receivables divided by revenue. In 2017, receivables was 14,700. Revenue was 81,000 multiplied by 100. Please work this out. What is the ratio? Please work this out. What do you have? Please work this out.
18.
18.1.
18.1.
18.15% approximately. Examiner said this ratio will not change. If you now get to 2018, we don't know receivables. Receivables in 2018, we don't know yet. But we know the revenue in 2018, 81,100. This must give us 18.15%. Because the examiner says this will remain unchanged. You can get receivable for 2018. That means in 2018, receivables is equal to 89,100 multiplied by 18.15. Please work this out. What do you have? Get receivables for 2018. What do you have?
1,617.
1,000.
617.
It can't be 1,000.
Oh, 1.6 million rather.
16,000.
Sorry.
16,000.
I not divide by 100.
72 naira.
16,000.
172.
172. Thank you. So please note, receivables is going to your balance sheet. So you are going to keep this working. Is that clear, please? If you also look at the question, he said credit giving to direct cost. Your credit giving this is working one. Assuming you have the question printed, we'll just be solving. The intent of this whiteboard is to make the class look like physical class. But what we expect is, if the question is shared to you, just print the question from your office. You can just single out those questions and print it and hold it. That's what we do in PM class. They have the question. I don't even bother about reading. I'll just read on my own question, physical, my hard copy. But SFN students, I don't know, maybe it's a challenge that's working too. Examiner says credit giving. That credit giving is payables over direct cost. I will refer you to it. You now check 2017. Check 2017. What is the payables? Let's share. Let me share quickly. We're trying to make the class as closer to the students. Look at where we are dealing with. We have treated this aspect, the amount of credit taken in proportion to revenue. That was receivables as a proportion of revenue. Look at the next thing. Credit giving in proportion to direct cost will not change. Your credit giving represents your payables. Now check 2017. Payables over indirect costs. Indirect costs multiplied by 100. Now 2017. Our payable figure was 12,900. Our indirect cost 45,600 multiplied by 100. Please find this ratio. What do you have? Please find this ratio. What do you have?
28.28.
28.28. Abi, or 29?
29. Yeah. Anyway.
9, Abi?
Yes, sir.
No problem. Where's my... Eraser. I can take my pen now. My pen. Two nine. It's too faint for me. Okay. Now go to 2018. Payables for 2018, I don't know yet. But I know direct cost for 2018, 49,248. This must equal to 28.29%. I can now calculate payables. Payables for 2018 is equal to 49,248 multiplied by 28.29%. Please don't forget percentage. What do you have here, please? What is payable for 2018?
13,932.25.
13,932 what?
932.
You can leave it at that. You keep
No, sir,
this.
that's not what I said.
Okay, what do you have?
932.
932. Okay.
Yes, sir.
I'll correct it, don't worry. It's just that 932. We move back to the material. Receivables and payables are items of financial statement. Look at it, please. For 2018, based on what we computed, receivables for 2018, 16,170. Whether you finance by equity or you finance by debt, in 2018, our receivables will become 16,170 or 172, Abi? I think 172. Our payables, please look at it here. Our payable figures in 2018, 13,932. Whether we finance by equity or we finance by debt, the payable figures will be 13,932. So you keep that in your balance sheet. Remember, we are following this paragraph by paragraph so that we don't miss out anything. We have treated up to this point. Next, the increase in the business will require increase in inventory by 5 million. Inventory is an item of balance sheet. Let's look at it. Please look at 2017. Inventory was 10,500. This will increase by 5 million. That is 5,000. That becomes, in 2018, the inventory figure will be 15,500. The inventory figure will be 15,500. Is that clear, please? Is that clear, please? Hello? Is that point clear?
Your voice
please?
was very faint before, sir.
What do you say?
Your voice was very faint before, but we can hear you now.
Okay, yeah, I was trying to take something, sorry. Okay, I'm saying that, let's go back to that note then. Look at the note. You know, we have treated this aspect. Please look at the highlighted. Amount of credit taken in proportion to revenue. We have treated this. Is that not, please? Hello?
Yes, sir, we've done that, sir.
We have also treated credit giving in proportion to direct cost. That is our payables. Are we there? Now look at the next. The increase in the business. We require increased inventory of 5 million naira. That means by the time we increase the business, inventory will also increase by 5 million. You now check the inventory figure for 2017. Check the inventory for 2017. What do you have? For 2017, please look at this. Look at the inventory figure. How much, please? 10,500. That is 10,500,000. Examiner says inventory will increase by 5 million. So in 2018, what will be your inventory figure? Hello? In 2018, what will be your inventory figure? Please, can you hear me? Please, can you hear me? Hello? Please, can you hear me?
Can hear you, sir.
I'm asking a question. Inventory will increase by 5 million. So what will be the inventory in 2018? Look at the figure. Please look at the figure. Inventories. In 2017, inventory was 10,500. We expect 5 million increase. That means in 2018, inventory will be 15,500. Whether we finance the project by equity or we finance the project by debt, inventory will increase by 5 million naira. We have treated that aspect of the question. We have gotten to this place now. Now look at the next note. Depreciation on non-current assets existing as at 30th December 2017 is forecast to be 5.7 per annum. Annual depreciation is 5,700,000 annually per annum. And it is forecast that 10 million of new non-current assets will be needed. This will be acquired in 2018. That means in 2018, we are going to increase our non-current assets. Definitely, or most likely, depreciation will also increase. Annual depreciation is 5.7. But because we are asset in 2018, the new asset will be depreciated or 18% reducing balance. That means in 2018, I'm going to have two depreciation. Depreciation on the existing asset. In 2018, I'm going to have two depreciation. Depreciation 5.7 million. Then depreciation on the new asset. The new asset is 10 million naira. Please compute 18% of 10 million. What do you have this? Depreciation on new asset. Please compute. 18% of 10 million naira. What do you have?
1.8.
1.8. That is depreciation on new asset plus depreciation on existing asset. 7.5. Please, 1.8 plus 5.7. 5.7 plus 1.8. What do you have, please?
7.5.
That means in 28, depreciation will be 7.5. Look at it here, please. Look at the solution. Look at the solution. The income statement. Look at the solution. Let's take it together. We'll still stop by 11. If we can do reasonable things, because it's not, the exam is fast approaching. Please look at it. Look at under 2018, 7,500. In 2017, annual depreciation was 5,700. But because in 2018, you are bringing in new asset of 10 million. So on the new asset, depreciation is 1.8. On the existing asset, depreciation is 7.5. 1.8 plus 7.5, that will give 1.8 plus 5.7. 5.7 plus 1.8, that will give you 7.5 million. That explains how we have gotten 7.5. We have explained revenue. We have explained direct cost. We have explained depreciation. We have explained indirect cost. Indirect cost is your overhead cost. You can now get profit before interest and tax. Please, let's do deduction. Revenue minus direct cost minus depreciation minus indirect cost. That will give you your profit before interest and tax. Please confirm this. Check figures here. Revenue minus direct cost minus depreciation minus indirect cost. That will give you 2352. Please, you can quickly confirm. So we have gotten up to these points. Internet unstable, is it today? Frustrating. We have gotten to these points. Look at this, please. The company pays tax at 21% per annum in the year in which liability arises. Capital allowance is equal to depreciation. We come back to that. Then we have annual dividends. Dividends will be paid 1 year, the year after the profit is earned. The company intends to maintain existing dividend payout. We also come back to that. Now let's look at interest payable. Let's look at the interest because we have gotten to that place now. Look at the interest. Interest payable in 2017 was 1,500. You can check. You have the income statement. Look at it. Interest payable in 2017, 1,500. Now in 2018, let me ask the class. If you finance the project by equity, will your interest increase? If you finance the project by equity, will your interest increase? Yes, my question. If you finance the project by equity, will your interest expense increase?
No, sir, it will not increase.
That's why we maintain 1,500. If the new project is financed by equity, that means interest will not increase. Now, but if you finance the new project by debt, will your interest increase?
Yes, sir. It will.
Now let's go to it. What is the interest on new debt? Don't worry. Look at the new debt. 15 million naira term loan. Please compute 8% of 15 million naira. That is the new interest on new loan. 8% of 15 million naira. What do you have?
1.2.
Okay, that's 1,200. So interest on existing loan, 1,500. Interest on new loan, 1,200. What is the total interest now? 15 plus 12. What do you have?
27.
Please notice. That's how we got the 27. You can now deduct it now. EBIT minus interest paid. That becomes profit before tax. Look at your profit before tax. If financed by equity, profit before tax is 18,852. If financed by debt, profit before tax is 17,632. Next, compute your tax. Please note, examiner says accounting depreciation is the same as capital allowance. That means your profit before tax is the same as your taxable profit. Please compute 21% tax. 21% of 16,200 will give you 3,402. You can check that out. 21% of 18,852 will give you 3,953. 21% of 17,632 will give you 3,707. You can now deduct your tax. You now get your profit after tax. Out. Profit after tax. In 2018, if the project is financed by equity, the profit after tax is 14,893. But if the project is financed by debt, the profit after tax is 13,925. Next, proposed dividends. Let's go and check this quickly. So that at least let's round up the income statement. Examiner says, look at these notes. Examiner says, annual dividends are payable the year after the year in which profits are earned. The company intends to maintain existing payout ratio. That means I must get existing payout ratio. Dividend payout ratio. That is your dividends divided by your profit after tax. Let's check 2017. In 2017, our dividend was, look at it, dividend was 7,679. Profit after tax was 12,798. Please divide it. 7,679 divided by 12,769 divided by 12,798 multiplied by 100. Please calculate the payout ratio. Dividend divided by profit after tax. That is the payout ratio. Please calculate that. This is what I'm saying. Our dividend payout ratio, this is what I'm saying. If I share this board to you, this is what I'm trying to say.
0.6.
I can, thank you, 0.6. That means dividend payout ratio is 60%. Examiner says the company intends to maintain this. 60% of our profit after tax will be dividends. Now go to 2018. Under equity financing, look at your profit after tax. 14,893. Please, 60% of this profit is your dividend payout. Please find 60% of 14,893. What do you have? That is proposed dividends.
8,935.8.
Approximately 8,936. That is how we got this 8,936. Check under debt financing. Profit after tax is 13,925. Compute 60% of this. That is your dividend payout.
$8,355.
Thank you. In case you are looking at the question again, proposed dividend. Now, please note, we have not paid dividend. So payment of dividends will happen in your statement of cash flow. We have just proposed it. The examiner says dividend will be paid a year after the profit is earned. That means dividend for 2017 will be paid in 2018. Dividend for 2018 will be paid in 2019. You can now get your retained earnings. Profit after tax minus proposed dividends. That will give you your retained earnings. Profit after tax minus the proposed dividend. That will give you your retained earnings. The profit after tax minus proposed dividend. That will give you your retained earnings.